Sam Richmond Brown, we've seen the VIX, the so-called fear index, bounce up and down between 15 and 22 so far this year. So should people change their asset allocation in response to all this choppiness?
Hi, Greg. I think that's a great question. Certainly, we feel the VIX is one measure of the fear in the markets. But what we feel is important with regards to asset allocation is to have a diversified portfolio. You mentioned the range, which is 15 to 22. By relative historical measurements, that's not, towards a market crisis in any way. We feel quite comfortable today in having a broad asset allocation approach, but integrating new sources of diversification, because we don't necessarily feel that history will repeat itself this time round.
Well, people say it's the Fed pulling out all that liquidity, which is causing the choppiness, the volatility in the market. What do you think? Do you agree with that assessment?
I mean, at Natixis, we certainly feel that, to some extent, the Fed is taking the training wheels off the economic cycle. So there's a lot of monetary policy divergence happening around the globe, and that's certainly having a repercussion on the equity markets and the level of volatility in the equity markets. So we do feel that there will be divergences around the globe as we go forward into 2015. But from an active manager point of view, we do feel that there are things to exploit. So again, back to my point on having a very broad, diversified portfolio, relying on different sources of risk and different sources of opportunity is in our view key.
So should people add, for example, hedge funds to their portfolio, or gold, or other supposedly non-correlated assets? Because the S&P really has gone straight up these past 2 years. Maybe it's time to get into something like hedge funds where you can balance that out.
Right. I think it's important to think in a non-traditional manner, and certainly our view is that equities and fixed income over the past period have been very complementary to each other, but also have benefited from this sort of decline in rates, in addition to this sort of supportive backdrop to equity markets. What we feel going forward is that it's important to introduce new sources of diversification. History won't repeat itself this time round, and we feel that looking towards sources of opportunities that are both uncorrelated to the bond markets, in addition to uncorrelated to the equity markets, makes a lot of sense.
And then finally, people still need bonds in their portfolio. So where are you going to find yield? Because if you do put your money into something like private equity or a hedge fund, it's not liquid, and you also don't get a lot of yield from those investments.
Right. Currently, we think also there is an issue with regards to the level of current yields, is that we don't necessarily feel that we're being compensated for the risk taken. At such low levels, I mean, the German 10-year being in line with the Japanese 10-year, we think is a real issue. And there is a need to look towards other sources of return. So again, having a very diversified portfolio, maybe taking on a whole lot of interest rate risk at this point of the cycle doesn't make sense, but there are other bond proxies. We feel comfortable today with a long dollar position, for instance, which we feel picks up the slack on the yield front. So again, having a very diversified portfolio makes a lot of sense.
All right, thanks a lot for coming in.
Thank you very much, Greg, for your time.
Thank you for watching The Street.